Welcome to our deep dive on dividend policy. In this video, we'll explore what dividend policy is, how companies decide on their payout strategies, and the impact on shareholders. We'll also cover some real-world examples and answer common questions investors have about dividends. First, let's define what a dividend policy is. Essentially, a dividend policy is a company's approach to distributing profits back to its shareholders. This policy determines how much is paid out in dividends, how often the dividends are distributed, and whether or not the company will retain a portion of the earnings for growth and reinvestment. Now, let's talk about the types of dividend policies that companies can adopt. The three main types are retained earnings policy, constant or stable dividend policy, and residual dividend policy. A retained earnings policy involves retaining all or most of the profits for reinvestment into the company rather than paying them out as dividends. This is often seen in high-growth companies that need capital to fuel their expansion. For example, many tech startups follow this policy. In contrast, a constant or stable dividend policy is where a company aims to pay a steady and predictable dividend each year, regardless of its earnings fluctuations. Old and well-established companies often follow this strategy, as it provides reliability for investors. Lastly, a residual dividend policy means that dividends are only paid after all suitable investment opportunities have been financed. This type focuses on paying dividends from leftover or residual profits. Let's delve into some real-world examples to understand these concepts better. Consider Apple Incorporated, which follows a hybrid approach. It retains some earnings for reinvestment while also paying a predictable dividend. Now, let's look at the data on Apple's dividend payouts over the last 5 years. As presented in the bar graph below, we can see the steady increase in dividend payouts, indicative of their commitment to a stable dividend policy. We can also consider a company like Amazon, which for many years retained all profits to fuel expansion, illustrating a classic example of a retained earnings policy. Recently, however, Amazon has shifted some focus towards paying dividends as they mature. Now, let's address the question, why do companies pay dividends? The primary motivation is to return value to shareholders. Dividends provide investors with immediate returns, which can be particularly attractive for income-focused investors. Let's look at historical data on dividend yields across multiple industries to understand how different sectors prioritize dividends. The line graph below shows that while technology companies generally have lower yields, utilities and financials often have higher rates. Next, some investors might wonder, what are the factors influencing a company's dividend policy? Key elements include profitability, cash flow, growth opportunities, taxation, and market expectations. Profitability and cash flow are crucial since companies with steady and strong earnings can afford to pay higher dividends. For instance, companies like Microsoft with robust profit margins have the luxury of offering generous dividends. Growth opportunities also play a significant role. Companies with high growth prospects might retain more earnings to reinvest instead of doling out dividends. This is typical for firms in evolving sectors like biotech and tech startups. Taxation policies can influence dividend decisions. For example, favorable tax treatments for dividends might encourage higher payouts, while higher taxes might lead companies to prefer share buybacks. Market expectations and investor profiles can pressure companies to conform to dividend norms within their industry. For example, income-focused investors might expect regular dividends from stocks in their portfolio, bringing reliability to their returns. Now let's answer a question that many investors have. Can a company change its dividend policy? Yes. A company can alter its policy as it evolves. This can be in response to changes in economic conditions, profit levels, or strategic shifts. For instance, General Electric cut its dividend during financial turmoil to conserve cash, highlighting how companies may adapt their policies to navigate challenging times. We can use a few simple equations to illustrate how dividends are determined. For example, the dividend payout ratio is calculated as if a company has annual dividends of $2 per share and earnings of $10 per share, The payout ratio would be 20%. This ratio helps evaluate how much of the earnings is distributed